Hi everyone. Today we will discuss about PCA or Prompt Corrective Action Framework because recently NBFCs or non-banking financial companies are also covered under PCA by RBI or Reserve Bank of India. In India, Reserve Bank of India is the regulator of all the banks, and already all other banks are covered under PCA, but at present RBI also has put this NBFCs under Prompt Corrective Action Framework. Okay, so because of that, let us see what is this PCA. Before that, we have to study what is this NBFCs are and what is the difference between this NBFC and other banks. Actually, these NBFCs are formed under Company Act of 1956. Okay, and some of the examples of this NBFCs are Muthoot Finance Limited, then we have IL&FS, then DHFL. All these companies are some of the major NBFCs in India. Okay, and if you are looking at the difference between an NBFC and other banks are, one is that these NBFCs are not a part of payment and settlement system, and another one is that they will not be able to accept demand deposit or DD. As they don't have capacity to accept DD, they will not be able to issue check also. In other banks, if we are having a deposit, they will be providing us check. We can use that check at any time. But in case of NBFC, they will not accept demand deposit and also they will not issue check, but they will be able to provide loan for us. Okay, so that is the difference between an NBFC and another private bank or commercial bank. Okay, so NBFCs are not a part of payment and settlement system. They will not be able to accept demand deposit and also they will not issue check for the customers. Okay, so this is the difference. Next, let us see what is this PCA. Actually, PCAs are a set of restrictions issued by the RBI. Okay. Banks, other banks were already under this PCA, and now RBI has also put this NBFCs under PCA. Okay, and I have listed about 3 major restrictions coming under this PCA here, and we will see what are they one by one. Okay, those major 3 are, first one is they will have to, or NBFCs have to maintain capital adequacy ratio, and there will be a restriction on the non-performing assets of the NBFC, and they will have to maintain tier 1 leverage ratio also. Okay, so let us see the first one, that is maintenance of capital adequacy ratio. Capital adequacy ratio, from the word itself you can say that it's the ratio of bank's capital to that of risk-weighted assets. Bank's capital means all the assets or all the capital that the bank is having is the bank's capital. From the word we can understand what is the capital of a bank's capital means. Okay, then risk-weighted assets means all the loans which is issued by the NBFCs are considered as its assets, because in the future their assets will be coming back to the NBFCs. Okay, so not only NBFCs, all the assets of all the banks are their loans. Their loans are their assets. Okay, so these loans are their assets, and there are different kinds of assets based on the risks. Okay, like if a person is taking loan from an NBFC, then if that person is a government employee, we can see that his job is permanent. Definitely every month he will get a certain amount as a salary, and definitely the NBFC will get that loan back, or principal or in its interest will be paid back regularly. Okay, so there is a surety that his job is giving. Okay, so that is considered as a less risk asset. But there are some assets or some loans which are high risk, because there is no surety that that loan will be paid back. Okay, so depending upon the risk, there are different type of assets. Okay, so based on the risk, the assets are classified, and bank's capital and these risk weighed assets, if we are looking at the ratio of these two, then that should be maintained to a level, and that level will be prescribed by the RBI. Okay, and RBI will say that you will have to maintain this ratio or this much ratio of your capital adequacy ratio. Then this bank NBFCs have to maintain that adequacy ratio in that NBFC. Okay, so that is the first point. Under PCA, RBI will say that this particular NBFC will have to maintain a capital adequacy ratio, and NBFC will have to follow that, which means that from the future onwards, NBFC will not be able to provide its loan to high risk category. They will have to reduce the high risk category so that it will be able to maintain the ratio. This is mainly for ensuring the stability and efficiency of the NBFC. Okay, so this is the first point, which means that they will have to maintain a capital adequacy ratio in the NBFC. Then second point is that non-performing assets, they will have to reduce or restrict the non-performing assets to a certain level. Let us see what is this non-performing asset is. Actually, a person got loan from the bank, and after a point of time, he will have to pay back this loan, including its interest. They will be paying back the loan as principal and interest. Okay, so if that person is not paying that interest plus principal back to the bank for a period of time, or is delaying the payment for a period of time, and that period of time is exceeding greater than 90 days, then we can put that asset or loan into non-performing asset. I told you that all the loans of a bank is the asset of that bank. Okay, so we will say that loan as asset, and that will turn into a non-performing asset if that particular person or the person who took that loan is not paying that loan for a period of 90 days. Okay, so that is a non-performing asset. Is non-performing asset means if a person is not paying his loan for a period of greater than 90 days. Okay, and if that kind of non-performing assets is exceeding too much for a NBFC, that is not good for the efficiency or the stability of the NBFC. Okay, so for maintaining the stability of that NBFC, RBI will be saying that the NBFC should not exceed its NPA or non-performing asset to a certain level, and NBFCs will have to obey that. Okay, so there will be a restriction on the non-performing assets of this NBFC. Already other banks are also maintaining these limitations. Okay, so that is the second one. The third one is Tier 1 leverage ratio. This is also again another ratio. This ratio means Tier 1 capital to that of total asset. Okay, Tier 1 capital to that of total asset. Total asset, I already told you, that is the asset of the NBFC, and Tier 1 capital means the core capital of the bank, which includes shares, reserves, and all the core capital for that NBFCs are the Tier 1 capital. If a ratio of that Tier 1 capital is taken as that of its total asset, that will form the Tier 1 leverage ratio. And in this case also, RBI will be saying that there will be a limit, or there will be a certain amount of or certain number of Tier 1 leverage ratio to be maintained by the NBFC, and NBFC will have to maintain that. Okay, so here I have told you that there is a 3 main restriction to be followed by the NBFC under PCA, which is mentioned by the RBI. They are mainly capital adequacy ratio, then they will have to restrict the non-performing assets, then they will also have to maintain Tier 1 leverage ratio. Okay, all these points are coming under this prompt corrective action framework by RBI. Why this or why such a kind of move by RBI? Because earlier there was no PCA for this NBFCs, but they are now put these NBFCs under PCA. So RBI has taken such a move because earlier there was a lot of problem with these NBFCs. Like you might have read about all these issues in the newspaper. Like there was a problem with IL&FS and there was a problem with DHFL. Okay, so because of that there was a lot of issues with the customers who have dealt with this major NBFCs. So in order to avoid the problem, such kind of problems in the future, RBI has taken this step of including NBFC under prompt corrective action. Okay, so these are the points that you have to remember about NBFCs as well as PCA. Okay, so that's all. Thank you.